Dan here with Victory X Financial, and we're here with Rico. Rico has been an outstanding client. He's a retired Navy veteran. He came to us last year in preparing for his full retirement, which is going to start in just a couple of years. And he wanted to maximize use of his savings in retirement while still having control of his money and not have to worry about market losses. So Rico, tell us about how your experience has been thus far working with Victory X Financial.
Hey Dan, thanks a lot for having me on here. One of the big things about Victory X that I really like was the insight that I could get on setting myself up for an 8% increase every year on my retirement. And that's up until the time that I start to use it. That, with my other streams of income, has just set me up where I don't have to worry about the downsides of the market. I won't be losing money on that. And I'm just going to be where I want to be. I'm going to get a paycheck until I finally go.
All right, so next question. So it's no secret that the economy is not doing great right now. Now we're here in April of 2026. The S&P is still down about 4% for the year. The NASDAQ is down about 6%. So people are losing money in their 401ks, their IRA accounts as we speak. How are your accounts doing?
Accounts are doing pretty good. A couple of years ago, just to share, when 2008 came around, when I was doing more 401ks and things like that, really took a big bite out of that. And it took some time to recover. Since I'm with this program, my annuities are set up in that 8%. It only increases. I don't lose money on this. And that's one of the biggest things that I liked about this program.
Beautiful, man. You got an 8% growth for up to 12 years. You'll never lose money. You have guaranteed income as long as you live. All right, last question, Rico. So I've made a promise to all of my clients that I will do my best to accommodate their schedules and that I'll make myself available outside of normal business hours, whether it be later in the evenings, weekends, holidays. What's been your experience with that?
My experience with you and Victory X is anytime, within reason, I can call and be responded back pretty quick. We've been texting back and forth as late as maybe 10 o'clock at night because we had some things that we needed to take care of. In fact, a day after Christmas, we were talking. He was available then. I was on a cruise in January, and then I'm out in the middle of the Caribbean, and I got a phone call from him just to follow up on things that I had working at that time. It's really done a lot for me.
Well, thank you, Rico. I definitely appreciate your time. Super glad to have you on board. I know you're going to enjoy a great retirement. So if you guys want to learn how these strategies can work for you, just go ahead and use that link on the screen or down below and check out our free training video. Again, this is Dan with Victory X Financial. Stay sharp, stay ready. All right, well, we are live. So welcome back, everyone. Welcome back to our patriotic office here, paying homage to the veteran community as we do at Victory X Financial. So for those of you that are new here tonight, I'm Dan Farnsworth. I'm a retired naval officer, founder of Victory X Financial, and author of Retire Max Elite, the Veteran's Guide to Tax-Free Wealth and Financial Freedom. So if you guys stick around throughout this video, if you comment wealth down in the comments section there, whether you're watching on YouTube or you're watching on Facebook, go ahead and comment wealth. I'm going to send you a free copy of one of our books. I'll even pay the shipping. So there you go. So we'll give you guys some reminders of that throughout the night. And over the next hour, we're going to be going over some very powerful information, some very good strategies that we work with here at Victory X Financial, and ways that we help veteran families to protect their savings, protect it from market crashes, grow it safely, grow it tax efficiently, and ultimately convert it into income that they're never going to outlive. Because that's our goal. We want to achieve financial peace of mind, and we want to mitigate as much risk as possible. We don't like risk. All right, so let's go ahead and dive on in. We've got a good presentation here. Let me remove that from the stage. Let's go ahead and add our presentation to the stage here tonight. So what are we going to be talking about tonight? Well, we are talking about how to turn your TSP into guaranteed lifetime income. So if you are a military veteran, whether you're separated or retired, or a federal civilian, separated or retired, or you're over the age of 59 and a half, this is a great opportunity to basically reposition money from your TSP so that it's no longer exposed to market risk that could ultimately cause you to lose money in the future. And before we move forward, I also want to point out right above us here, you'll see a QR code. So if at any point you guys have any questions or you'd like to go ahead and book a follow-on appointment, we offer free consultations, absolutely no obligations whatsoever. You can use that QR code. I also put the Calendly link down in the comments. So if you guys want to use that link, you can book a free financial strategies phone call with myself or a member of our team, and we will reach out to you at that scheduled appointment date or time, and we can talk about your situation. In the meantime, if you guys have questions here tonight, feel free to drop them in the comments at any time. We'll be monitoring that, and we'll make sure we get every question answered. I'll even hang back for a few minutes afterwards once we finish the presentation. All right, so let's dive on in here. So again, if you guys are just joining us, I'm Dan Farnsworth, retired naval officer, served 23 years active duty. For about 15 of those years, I studied and I developed financial strategies that were outside of the realm of traditional investing. Okay, I kind of saw it as like a personal mission, to find ways to protect my money, to grow my money in ways that didn't expose it to the risks that we have in traditional investment scenarios. Okay, we saw what happened in 2008. We saw what happened right after 9/11. We saw what happened in 2022 after COVID. And those were all major market hits that all happened within about a 20-year period that caused people to lose a lot of money. Okay. Our goal here is to help people achieve financial peace of mind, right? We want to inspire confidence. We want people to be able to enjoy their savings. And ultimately, we want to be able to help veteran families to achieve these goals. Okay. Also, like I said, the author of Retire Max Elite, which we'll be giving away again, free copies of the book. If you guys comment wealth down in the comments below, we'll be sending these out to you. And again, I'll cover the shipping on that. All right. So what are we talking about? Well, we're talking about probably the number one risk that almost nobody talks about when it comes to retirement planning, and the number one reason why retirement plans can fail. And that is, we start talking about things like sequence of returns risk. Okay. And we'll kind of get into what that is, how it can impact you, and what those numbers actually look like in a retirement situation or retirement plan and how they can affect it. Okay. We're going to use real numbers. Okay. I don't like to just use make-believe numbers. I don't like to use hypotheticals. We're going to look back at real returns. Now, of course, every TSP portfolio is going to be diversified a little bit differently, but we're going to use actual real numbers, combinations of C fund, S fund, I fund, and even G fund to give us an idea of what this portfolio could potentially look like and how we can ultimately benefit it. Okay. And then ultimately, we're going to talk about a strategy for creating income off of that portfolio, converting that portfolio into income that neither you nor your spouse can ever outlive. Okay, it's money that's going to last as long as you do. All right, so the first question that you want to ask yourself is, will your money last as long as you do? Okay, this is a major, major concern. In fact, there are a lot of folks that actually fear this more than death itself, right? The idea of outliving your money, right? The idea of essentially running out of money when you're 75 or 78 years old, or, in the case of married couples, the idea of one spouse predeceasing the other and leaving them basically in financial ruin with not enough money to live on. Okay. That's a very real concern. And it's a concern that has come to, real life fruition for a lot of couples, unfortunately, over the last 20 to 30 years. Right. So that's what we're going to be exploring here. That's the only question that really matters in retirement planning. All right. Everything else, when it comes to your accumulations, your returns, any kind of diversification strategies, it really boils down to that one question. Will your money last as long as you do? And will you be able to enjoy it? Right. Because yeah, it's easy to just keep it locked up in a savings account, right? I mean, that's safe, that's stable, but what good does that do you? You want to die and become the richest guy in the graveyard, or do you want to be able to enjoy your savings with more peace of mind and to be able to spend more of it and, know for a fact that you're not going to run out of money? All right, so we're going to give you just kind of a hypothetical example, and we're going to be talking about a fictitious couple, but again, using real world numbers as we will, okay? So in our scenario tonight, we've got basically a 60-year-old couple, okay? Husband and wife, both 60 years old, with about 300,000 in a TSP account. Obviously, you know, it's been a long time since, you know, maybe they served in the military, but here we are in, you know, in preparing for retirement. The husband's still working. Maybe he's doing some, you know, work with the government. Maybe he's contracting. Maybe he's just doing something in the private sector, right? But he's planning to work until 62. And he wants to be able to start drawing income off of his TSP. And we'll just say in this scenario, we're going to kind of look into the crystal ball a little bit. And we'll just, you know, for context's sake, we'll say that the couple is going to live, the husband's going to live until age 80, and the wife is going to live until age 85. So he's going to predecease her, and she's going to live until 85. And again, they have $300,000 in their TSP, and maybe they receive some other, you know, mailbox money. It could be VA compensation, it could be a pension, but we're going to focus solely on the TSP for what we're going to go over tonight. All right, so what do most people do with their TSP? Well, to be honest, most people just leave it in there, right? They keep the full balance invested. And if you look at the retirement calculators that exist on, you know, like the DFAST site, for instance, they'll ask you questions when you're running the calculations. What do you expect your return rates to be during your accumulation phase, your working years? And what do you expect the return rate to be in your retired years? And why would they ask you for the difference, right? Why would they just assume that there's going to be a difference in the rate of return? Well, the reason is because most retirees, they don't want to take risk, right, while they're in retirement. They don't want to risk running out of money when they're, you know, 75 years old and having to potentially go back to work or figure out some other, you know, form of income, you know, have their kids support them or something, right? So what they typically will do is they will move their money into, you know, into allocations like the G fund, for instance. Right. And what will they accomplish? Well, they'll put it in a safer place, right? Maybe they'll put more money into a savings account or whatever, you know, but they're also going to severely limit their rates of return if they do that. Okay. They're going to take their earning potential from potentially, you know, 10 to 13% or so, all the way down to about 3 to 4%. And then what are you going to do? Well, are you going to, you know, withdraw 4% a year, just follow the 4% rule like the financial advisor wants you to follow, right? Why do they recommend the 4% rule, taking only 4% of your principal every year? Well, it's because they want to be able to mitigate things like market volatility, and they also are going to be charging you management fees. Okay, so at least 1 to 1.5% or so a year is coming right off of your principal base and going right into the brokerage's pocket, basically, right, for managing your money. Yes, TSP is going to be a little bit lower than that. However, your money is still subject to volatility. And as such, they're not going to recommend that you keep your money in places like the C fund, where you could potentially lose, you know, like we saw in 2008, up to 40% overnight. And I'll show you what that looks like. Okay. So what most people do is, again, they just leave it in there and they plan to just withdraw income annually, okay, and they just hope that the market cooperates. Well, we know for a fact that markets don't always cooperate, right? There's a lot of volatility that exists, okay? That's a very real thing. We know that this is a crazy world that we live in. There's all kinds of, you know, factors that play a role in how economic speculation takes place. And what we've seen just over the last several months with, you know, ongoing, you know, warring efforts, et cetera, and of course the closures within the Strait of Hormuz and that sort of stuff, that's all going to affect economic speculation, okay? And it's going to cause the markets to go on the roller coaster that the markets just go on, okay? And ultimately that's going to, you know, impact your ability to draw from your principal over time. Okay, so the logic that most people use, of course, is that the stock market has historically returned roughly about 7 to 10% a year. Okay, we're talking primarily about the S&P 500. So if you were to withdraw, let's say 8 to 9%, you're just spending your returns. Okay, and that's with the brokerage. When you go to, you know, you name it, whatever brokerage, okay? We know what they are, right? We know which ones. You go to the brokerage and the financial advisor is going to tell you that, if the markets are historically returning 7 to 10% a year, that you could withdraw, potentially 8 to 9%, because all you're doing is you're just spending your returns and you're not actually depleting your principal. And that math does seem to work when you factor in historical averages, okay? Because again, the historical average has been 7 to 10%. So it just kind of feels like you're on this self-sustaining machine. But the problem is that the order in which those returns occur makes a huge difference as to what your principal balance is going to be year to year and what 8 to 9% will ultimately do to your principal. Okay, the problem is not the average return. We know what the average return is, right? The average return, 7 to 10%, okay, should be a no-brainer, right? But a single bad year can literally cause permanent damage to an income plan, and it can happen at the worst possible time, all right? And in many cases, it absolutely did. Okay, when you look at the impacts of 2008, right, we saw just in the US alone, we saw about a 7%. Now, keep in mind, these are global statistics, right? These are huge numbers. We saw a 7% increase, sharp 7% increase in suicides between 2008 and 2009, mostly among men in the US that were ages 45 to 60. And why do we think that there was such a sharp increase in suicides in that particular demographic? Well, because those are the exact people that I'm speaking to right now. Okay, folks that were planning their retirements, planning their futures and their families' futures based on their savings that were invested in the markets that were averaging 7 to 10% per year. But then they got hit with a 40% loss in 1 year, and it completely destroyed everything. Okay. And that's where people get into serious trouble, and most people never see it coming, right? Did we see this Iran situation coming? I didn't, most of us were pretty shocked to learn that all of a sudden we woke up one day in January and the world's on fire again, okay? We've kind of come to expect that we're, going to be dealing with, this sort of global turmoil, but we certainly didn't expect that situation. Did we expect COVID to come along? Who could have predicted it, right? So again, most people never see this stuff coming. It comes in like a tornado, and then ultimately the losses are permanent, okay? Whether you crawl your way back to where you were before will depend on future market performance. But when your money is invested in commodities and those commodities lose value overnight, those losses are permanent. Then you have to work your way back up. So those are new gains on top of what you've already earned. Okay. So let's talk about sequence of returns. So sequence of returns risk is probably the most dangerous and least discussed risk in retirement. Because again, most advisors will sit there and work off of averages. The market doesn't go up in a straight line, okay? So again, the timing of how you're trying to withdraw from your savings is going to have a huge impact on how much you can take safely per year without running out of money, okay? And if you incur early losses, and you want to still continue to withdraw at higher rates, you're going to create a hole that you may not ever be able to climb out of, okay? Because the account ultimately, might start to recover, but in the end, you're still drawing it down at the same percentages. And so what ends up happening? Well, most people, you would think, let me ask you this. If I asked you the question, do you think that more people run out of money in their lives or they end up dying with large sums of money that they never got to enjoy? What do you think the answer is? And I can tell you, I'm just gonna give you the answer, right? The answer is most people end up dying with more money in the bank, right? More money in their savings accounts because they were afraid to spend it. Okay, we know, studies have shown actually that couples with predictable income streams in retirement, or just in general, just predictable income streams, spend more money. They enjoy more money, right? They enjoy the savings that they work so hard to build, right? Because if they're worried that the markets could potentially crash or that they're going to outlive their money, what do they end up doing? Well, they end up hoarding it, right? And instead of taking the 4% that was, maybe was recommended, now they're only taking maybe 2% a year, right? And all that money is just sitting there in the bank, just waiting for someday to get withdrawn. Maybe it goes up, maybe it goes down, but people never get to take advantage of that. All right. So let's look at just some examples, just based on a four-year period of time with market performance. Okay, so we talk about sequence of returns. If we take this over a 4-year period, let's say in year 1, the markets earned 20%. Okay, great. Awesome. Everybody's, cha-ching, confidence is high. We just earned 20% on our savings that year. Okay, but in year 2, we took an 18% hit. So again, significant loss. And at this time, obviously, we're starting to take withdrawals. Year 3, maybe we're back up 12%. We're still technically down, slightly, right? Because we had lost 18% in that second year. And again, that was 18% of what you had earned and compounded from year 1, right? So let's say you started with $100,000 and you earned $20,000, okay? If you lost 18%, you're losing 18% of 120,000, not the original 100, okay? Now we come back up 12%, so the recovery begins, of course, but on a smaller basis, okay? And then in year 4, maybe we take another hit, another down 10%. At the beginning of this year, the markets were down about 7%. Okay, so if we take another 10% hit, again, we're still on that market roller coaster. Now, the average return, of course, across these 4 years, it looks like it's survivable. I mean, because let's face it, if we started with 20 and we minus 18 plus 12 minus 10, okay, that's basically, it's showing that, hey, we're up 4%, right? But in reality, like I said, it's taking a much bigger bite out of what we're able to draw every single year. Now, let's put the real numbers to the risk. Okay, so if we started with, let's say, 300,000, okay, at age 60, and we're ready to start generating income at age 62, okay, and we're going to target 8.5% annual withdrawal rate, and we're just, for the sake of, again, future projections, we're going to say that we're going to do this over the course of 20 or maybe 25 years. All right, what do those numbers actually look like? Well, again, the income looks fine at first. So in years 1 through 3, let's say we're targeting an 8.5% withdrawal rate every single year. Well, that's going to be roughly about $24,000 to $27,000 a year. And that feels, again, pretty sustainable, right? If you just earn 20%, you're like, man, I can just keep drawing this out and shouldn't have any problems, right? I just cleared, at least 12% or, almost 11.5%, 12%. Above what I was drawing, so I'm good to go. Okay, but again, that creates a sense of security that the plan is working, but we also have to be cognizant of future losses. Okay, and this is where most people stop thinking critically about their plan, but we don't want to stop here. Okay, so let's just say, for instance, we're going to factor in the effects of a market crash. Okay, so it's really not a matter of if, it's a matter of when. All right, the markets, the market declines of anywhere from 20 to 40% have occurred multiple times. We just talked about that. 2000, 2001. We actually saw 3 straight years. It was the first time in the last 100 years that the S&P has saw 3 consecutive down years: 2000, 2001, and 2002. And then again, a major global economic crisis in 2008, which saw major losses: 38% in the S&P, 40% in the TSP fund. Okay. And what happens to income? Well, let's assume that we were drawing about 27,000 off of that initial 300K. Okay, so the couple feels very comfortable. The bills are covered. Everything feels stable. We're on track. Okay, but after the crash, because of the amount of loss that we basically took in the principal, that annual income is now going to drop to approximately $10,000. It was more than cut in half. It was almost severed down to a third of what they were able to safely draw every single year. And this literally happens overnight. It's not gradual, literally overnight. Okay, so then again, the market recovers, But remember, in order for the market to recover, it's going to have a spectacular recovery in order for you to even get back to where you were before. Okay. The S&P has always come back. And in most cases, we see, pretty strong returns in the years after major crashes or corrections. But if you're withdrawing, money in that process and you're trying to have some kind of predictability in your income, well, your account might survive and it's going to continue to exist, but your income is never really going to recover from that. And in the end, that's really what matters, right? Yeah, having a huge sum of money that you can admire and, log into your account and see some big spectacular balance, that's awesome, I guess. But does it really translate to being able to enjoy your retirement? Does it really translate to being able to use your savings to really live on your savings every single year? It's kind of like having a house that's worth, $1 million. Yeah, it's great. You got a house that's worth $1 million. You can, go in it, look at it, cut the grass, admire it, send pictures to your friends, check out the ads on Trulia and see that you live in $1 million home. But how much of that is actually liquid money? Does owning $1 million house make you a millionaire? Well, probably not, right? Because as we've said before, many times on the channel, you can't go to the grocery store and buy a candy bar with a piece of drywall. Okay. It's the same with your, with savings that's just sitting there invested in equities and commodities in the stock market, right? That money is being held, within those equities. It's not liquid cash in that moment. In order to liquidate that, you have to sell those commodities, right? You have to sell off the equities that you own, sell those shares. That's how you take those withdrawals. And frankly, Wall Street was never really designed for that. Okay. Wall Street was designed for you to put money in. It wasn't really designed for you to take money out. Okay. And we see this really typified, with a lot of financial firms, maybe not as much with TSP, but we do see it with other brokerages where, they tend to, kind of give clients a little bit of a hard time sometimes when they want to access their money, especially if they're going above and beyond that 4%. All right. So let's look at the real numbers here. Okay. So again, we said we started out with a $300,000 balance, and we looked at it over the course of, we initially looked at it over the course of 4 years. Now we're going to look at it over the course of about 20 years. Okay. So we're going to introduce a market crash at roughly age 72. Okay. So we're going to assume in this case that maybe they were, 62, 10 years prior to 2008, for instance, right? So we're going to simulate a market crash at age 72. So we're looking at real returns, okay? So we can see here, in that first year, we're up to 311,000. Maybe we had a negative 8% return, but we were still able to take about 24,000, and we still ended up with about 262 in the balance, okay? The next year, we were up 15. We took a solid 25,000. We ended with about 275, okay, and so on and so forth. So we get all the way down here. We get down to age 71. Now you can see our income. We're targeting 8.5%. So we're kind of pushing the envelope here, right? We're targeting 8.5%. And so far, we've been doing okay. All right. So far, we've been generating a predictable income stream, 24 to 25, even 27,000 in that last year. And then the crash hits, right? So then the crash hits at age 72. And what happens? 38% lost overnight. So we started with 191,000 that year. Okay. And it dropped down to 108,000. Okay. Is that the kind of thing that you want to have happen when you're 72 years old and you've been retired for 10 years, right? Do you want to be sitting there trying to fund your golf green fees at 72, worried about having to go back to work or how you're going to come up with money to pay for the groceries, the gas bills, and everything else when your account savings just dropped by 38%? This was a reality, folks. It was a reality for many, many people. Millions of people, in fact, who saw a major market loss again in 2008. And then they got hit again in 2022. It was a 20% loss. All right. So these losses that occur, even though, again, we go back to these numbers. I mean, look, we got 15% year. We had a 20% year in there, a 14%. There were more up years than there were down years. But all it took was one down year. All it took was one to just completely wipe out the entire plan. And now we're down from 27,000 a year. We've been used to that for the last 10 years, and now we're down to 10,000 a year. And it gets worse from there. Okay. So again, two strategies, two completely different lives, right? When we see the ages 62 to 65, we saw 24,000 to 27,000 in the TSP withdrawals, but then we had a crash year, dropped it to 10,000 roughly a year overnight. Okay, the income remains permanently reduced. And then at age 80, the husband passes away. So whatever the depleted account, still had in it, I mean, wife still had to live, 5 more years on a significantly reduced income, right? That just totally derailed the whole plan. Okay. So it's not just about running out of money. Okay. The risk isn't always just a dramatic zero balance account, but the pain is definitely a more subtle and a more prolonged thing, right? It's losing significant income when you need it the most. Okay. The last thing that we want to do is to pass away and leave our widows with, a financial situation that's extremely uncomfortable for them, fearing even more because, again, they've been drawing as much as they possibly can up to that point, fearing even more that they're going to run out of money completely. That's not the situation that we want to leave our husbands and wives when we leave this world, right? We don't want to leave behind a situation where that person has even more stress in the final years of their life, worrying about how much they can take of whatever's left over because they're worried about actually running out and literally dropping it down to zero. Okay, so let's back up for a second. So we're going to talk a little bit about our private pension strategy and how we can basically lock in guaranteed income for both spouses and how that's going to compare to our dismal scenario that we just described. Okay, so let's go ahead and jump forward. Again, we're going to talk about after the crash. All right, so we're kind of backtracking a second here. We said, okay, the crash happened at age 72. Okay, now again, look at our returns again. We had an 18% year following the next year. Then we had 5%, 9, 7. Okay, so we had 4 consecutive positive years. But that crash, man, look at where our income is. Our income is still taking 8.5% of our balance, and we're not even keeping up. So that income keeps dropping. Then we get a little bit of a boost at age 78, okay, and it goes back up. So now we're hovering around 10,000. But boom, we hit another loss at age 83. Now we're down to $4,500 a year. Okay, that's what our widowed spouse is now able to take off of what was once a $300,000 savings nest egg. Okay, imagine the amount of sacrifice that couple had to endure to just create that $300,000 nest egg that was supposed to last forever, but didn't. Okay, it didn't. And now, let's say she passes away at age 85. Well, she's got about $45,000 left in there. Okay, and that's assuming that we don't incur any other market losses in that amount of time. Okay, so about $45,000 is probably going to pass on to the family. They're going to pay some tax on that, okay, because that's all pre-tax dollars. We haven't talked about any Roth conversions or anything. So guess what? They're going to lose probably another 20 to 30% of that, okay, and it's going to impact their income tax bracket potentially for the year. So again, it's Uncle Sam is going to take a much larger cut. Okay, if the receiving, the beneficiaries of that are, let's say nearing the age of being able to take Social Security or Medicare, then guess what? That's going to impact them as well. Okay, so again, passing away at age 85 with $45,000 left in your savings that was once $300,000 and only being able to take $6,200 that year because we were, again, trying to target that 8.5%. Okay, so what happens? Well, we just talked about that. Husband passes away at 80. The wife's 80 years old, potentially has 5 more years. Of course, she's not going to know that at the time, but we're just assuming, okay? So again, she's going to inherit whatever remains. It's going to be a depleted, damaged account. It's going to generate reduced income. Now, she didn't cause this problem, okay? But she just has to live with it. The market caused the problem, but she has to live with it. All right, so again, not dying early. It's living too long with unstable income. And that is ultimately what we are seeking to mitigate. And how are we going to do that? Well, we're going to look at this from 3 different angles. Obviously, we look at market risk, we look at longevity risk, and we look at sequence of risk, right? So our goal in our strategy, in our peace of mind strategy, is to ultimately satisfy and to mitigate all 3 of those risks, right? We want to take out market risk completely. Okay, we don't want market volatility to determine how much you can take every single year, right? As veterans especially, we're used to living on predictable income streams, okay? We live off of pay grades and pay tables, okay, where we know what our allowances and we know what our base pays and we know what our pensions and our VA income, it's all based off of grids, right? It's predictable mailbox money is what we call it, right? It gets deposited every month. We know how much is coming in. We know what it's going to look like in the future. And because of that, we're not worried about running out, right? And we're not worried about being able to go out there and spend the money, enjoy the money, and ultimately, have a great retirement and ultimately pass on, some money and leave it behind so that we take care of our spouses and our families when we go. Okay. We also don't want to have to worry about how long we're going to live. Okay. Longevity risk is a real thing as well, right? It's not just the volatility. It's that ultimately, if let's say you're drawing at 8 or 9%, but your account's only earning 4 to 5, well, eventually that's going to run out, right? Math is math. So we want to be able to mitigate the longevity risk. And then ultimately, we also want to mitigate that sequence of returns, right? We don't want, whether the market takes a 7% hit or a 10%, increase year to year, we don't want the order of those returns to have any impact whatsoever on how much we're able to use our savings in retirement. Okay. So again, with the traditional strategy, we focus on growth. Okay. That's what our TSP accounts are designed to do, is to focus on growth. They have no guarantees whatsoever. None. Okay. The military, for what it's worth, will tout the TSP. The government will tout the TSP as a very safe place to put your money, but there are no guarantees in that. None. Okay. You get participation in the market upside. It's familiar, it's flexible, you can diversify, works well during accumulation years, but in the end, there's no income guarantee. There's no protection against that sequence of returns. There's no spouse continuation guarantee. Okay. If the money runs out, the money runs out. And there's no floor on how far it can fall, right? We happen to see one of the largest drops in the entire, over the last 100 years just take place in 2008. But there's no limit as to how far that can fall. I mean, it could fall 50%, 60%. We don't know. There's no floor whatsoever. There's no built-in safety net. So really, the accumulation strategy in the market, incurring risk, works until it doesn't. All right, so what if you could all fix all 3? Well, that's exactly what we're seeking to do. We want to eliminate market risk. We want to guarantee lifetime payments. We want to protect our spouses, okay, so that we have joint survivorship income that's going to be completely uninterrupted. Okay, I don't want to get off on a tangent about the survivor benefit plan, but we can save that for another video. But suffice to say, if you're paying for SBP, right, the survivor benefit plan, if you think that that's just going to kick on immediately the minute you exit the earth and leave your widowed spouse here, if you think that income's just going to kick on, I would highly encourage you to rethink that strategy, because it's going to take months. Okay, it literally is going to take months, and in that time, the mortgage bills, the grocery bills, the gas bills, none of that stops. Okay, what does stop is the income, right? Until it picks up again, and even then, it's going to be severely limited in comparison to what she was receiving, or he or she was receiving before. Okay, but in this case, what we're doing is we're creating completely uninterrupted income, completely uninterrupted, right? There are no hiccups, there are no delays, no gaps in that revenue. It just keeps on coming in as if it was completely unaffected. Okay, and that's what we want to seek to do. That's what we are seeking to do with this particular strategy. All right. So again, we're going to talk about our private pension strategy for veterans. Okay. We want to ultimately convert your savings into guaranteed lifetime income. Now, we want to do this in a way that breaks away from historical, what we called SPIAs and DIAs. Okay. A SPIA was a single premium immediate annuity. Okay. A DIA was a deferred income annuity. And when you look at the TSP actually has annuities built into it. That's exactly what they are. They're SPIAs and they're DIAs. Okay. So what that basically equates to is you're sort of like trading in a large sum of cash, right? So that 300,000, let's say, you're trading that in to receive a moderate annual payment off of it, right? An annuity, right? Your pension, by the way, is an annuity. Okay. You finance that over the course of 20 plus years if you retire from the Navy. Well, retire from the military. Okay. I retire from the Navy. But your pension is a form of an annuity. It's just like I said, that's something you essentially finance that with unrealized gains on your income the entire time. And most military members, especially if you stayed in longer than, let's say, 10 or 12 years, are going to stick around for that because that mailbox money means a lot more than just getting that higher income along the way. Okay. But when we look at this from the standpoint of the modern solutions, right, the modern market protected private pension accounts, you still control your principal. Okay. You're not just trading in a $300,000 balance to just get 20 some odd thousand a year, right? You still control that principal. That principal still continues to grow, but it grows with market protection so that it's not just continued to get exposed to risk and volatility, right? It's not just exposed to the risks in the market where it could just get wiped out overnight. That money still continues to grow. You still have access to that money while you're still continuing to draw income that's guaranteed for life. Okay. And that's the essence of the private pension strategy. It's using proven financial instruments, okay, ones that most of our clients really don't have a lot of exposure to because these just they're not very prevalent within the military and the government communities, okay? And there's a number of reasons for that, right? But our goal as an agency, my goal as a financial professional is to provide that exposure and that awareness to these types of strategies because they are so valuable and they are so powerful. Okay. Income that you can't outlive without losing control of your money. All right. So 3 simple steps. So we take basically all we're doing is just repositioning your savings, from an at-risk account into a market protected account. Now, whether we go through an accumulation phase, a market protected accumulation phase, whether we run one concurrently with the income strategy, that's going to depend entirely on your situation, right? What is your level of risk tolerance, right? Do you want all of your money to be protected in a protected, accumulation or income or a combination of those 2 strategies? Okay, but either way, we want to move the savings away from the markets, right? Because in the end, we don't want the money just sitting there at risk in the stock market while you're trying to draw a comfortable retirement. Now, this is going to come with literally 0 out-of-pocket costs, right? As an advisor in my role, right, I don't have to charge my clients any money whatsoever, right? I don't have to charge any kind of management fees that's going to drain on your principal every single year, and that's going to cause, let's say someone in my position to want to persuade you against ever taking your money. Okay, because I'm not benefiting from that. I would not benefit at all if you just simply withdrew 8 or 9%, or if you withdrew less than 8 or 9%, right? There's no benefit in that for me as the overseeing, the writing agent on your policies and on your contracts. Okay. So ultimately we want to just simply move the savings. Again, no out-of-pocket costs, no management fees. We get guarantees that are going to come from A-rated insurance companies, okay? Extremely strong financial profiles. In fact, they're regulated more heavily even than the banks, okay? The insurance companies that we work with are A-rated, in some cases B++, but their financial profiles match the A-rated carriers, okay? And they're going to have guarantees built into these strategies that are backed by you've got states guarantee associations, you've got the A-rated financial profiles, you've got in some cases over 100 years of proven financial stability and solvency that's going to go into these type of companies, right? That is going to go into these strategies and is going to protect your principal. Okay. And then ultimately they do what insurance companies do. No, they're not just taking your money. Okay. There's a myth out there. We hear it circulated in the channels about, oh, the insurance companies, they just take your money and just give you the scraps. No, they don't. They're constantly looking for ways that they can liquidate these accounts to the highest degree possible. Okay. That they can protect your funds, right? That they can control volatility and that they can achieve the highest possible payouts for, based on your principal values, whether that means including bonuses or anything else, right? The highest possible principal payouts. That's their goal. That's how they make their money, right? That's how they grow their companies. And that's how they've grown to such, levels of success, because they're competing in that space to give you the most amount of access to your funds. Okay. And ultimately we want these incomes, whenever you decide to turn on the income, we want that to last for life. Okay. We want it to be guaranteed. We want it to be at a substantial rate, right? We want it to be extremely competitive in the markets. Again, we're talking 8.5%, possibly even higher, right? Could be 8, could be 9, could be 10. Okay. But we want that to be contractually guaranteed. We want it to be sustainable. Okay. And we want you to maintain control of the money. So again, when we compare the market strategy to our private pension option, okay, when you're talking about the factors, that exist, the income, the duration, the market dependency, spouse protection, planning certainty, okay, you can see here just where the contrasts exist. Okay. A market strategy is going to fluctuate every year. We show that. It can run out. At any time, it could run out. Okay. It's entirely dependent on the roller coaster that too many folks ride in the market. And in the end, whatever remains, that's what your annual percentages are based off of. Okay. And there's very low certainty in any of that. Again, Wall Street does not come with any guarantees whatsoever, but ours do. So when you look at the private pension strategy, okay, we're talking about a fixed income. It's the same every year. It's guaranteed for life, has zero market exposure, right? Insurance companies do what insurance companies do. They absorb risk so that you don't have to, okay? And they've got full continuation. So if you pass away before your spouse is going to receive the income for the rest of their life. And that gives you extremely high confidence and extremely high ability to plan your retirement. Okay. It really is that simple. Okay. So in our strategy, rather than playing the markets and saying, okay, 27,000 this year, 26 that year, 25, oh no, then it crashed and we're down to 10. We're going to guarantee 25,000, almost 26,000 per year. That's going to be guaranteed for life. And that's joint lifetime coverage. Okay, so again, in the scenario involving our 60-year-old couple, if the husband lives to 80, his wife is still going to receive almost $26,000 guaranteed. They don't have to lose a wink of sleep ever, right? If the markets crash tomorrow, they go, yeah, that kind of sucks. I mean, I hope we didn't lose any value in our home, but in the end, their money, even their principal, right? That $300,000 is still growing in the market. And if the markets crash tomorrow, you know how much they're going to lose? Zero. They're not going to lose any money because it's protected. It's in a market protected position. And in the end, they're going to be able to turn on income. They can turn on that income any age that they want to. If they waited another year or two, it's going to be higher, guaranteed. They have what they call guaranteed compounding roll-ups every single year. So every year that they defer, they're going to get more and more money guaranteed for life, locked in. Okay. So you think over the course of, let's say, 85 minus 62, that's a 23-year period. Okay. So over 23 years, if they're drawing 25,740 a year, let's say, you're talking about almost $593,000. Again, guaranteed off of a $300,000 rollover that didn't cost them a dime Didn't cost them a dime in out-of-pocket costs. They drew almost $600,000, 3 times the principal value over their lifetime. And that was basically starting this strategy at age 62, right? Or well, 60, right? So they started drawing income at 62. 62, by the way, is a pretty aggressive age to start drawing retirement income. And yet they were still able to draw almost $600,000 and would potentially still have principal left over. Okay. And there's other strategies that we can incorporate on top of this that will also guarantee that you'll have a legacy benefit that's going to pass on to your kids and grandkids at the end of your life. Okay. So again, the picture that changes how people think about retirement when you put both strategies side by side. Okay. Early retirement, 62 is considered early retirement. Okay. And if they were wanting to draw off of a 300,000 principal, it's going to be somewhere between 24 and 27. Okay. But in that crash year, if that crash year takes place at age 72, that 24 to 27 falls to 10K overnight. Okay. And after that, it never recovers. The highest it gets to is around 11 grand. And then it falls again, right? Husband passes away. Wife is sitting there drawing 5,000 a year, right? At age 80, what's she going to do? Go back to work, So, you think about the impact of that, right? But our private pension strategy is going to lock in that income. It's contractually guaranteed with an A-rated carrier with a long history of financial solvency that is in the game for clients. Okay. They're not in the game for Wall Street, right? They're not in the game to just sit there and play with the markets, right? They've got the majority of their general fund is invested in bonds, treasury bonds. Okay. It's money that's very well protected, right? Very, very stable. It earns, a moderate rate of return. They have options budgets that they use in the index strategies. The options budgets are used to kind of help plus up your remaining principal balances. But in the end, these are contractually guaranteed income amounts that are going to continue for the rest of your life and the rest of your spouse's life, regardless of what happens in the market and regardless of how long you live. Okay, both of you. And in this case, the private pension strategy, which we would compare, by the way, if we were doing this on an individual basis, we run the numbers based on many, many carriers. Every single one that's out there in the market, we can compare these numbers to, and we can see that $25,740 a year was the highest that we had available to us based on their projections for their what they wanted to take and what age they wanted to take retirement. So over a 23-year span, we're going to deliver more than $592,000, much more certainty and complete peace of mind for both spouses for life. All right. So when people see these numbers, right, they say, oh, I didn't realize that income can drop like that. Most people don't, right? Because nobody really talks about it, right? We're all focused on accumulation, right? We're all focused on how much can we save. We got folks that are like super savers, right? They just stocking it away. Well, then that same mentality still translates into the later years. And again, we see folks end up going to the grave with hundreds of thousands, potentially even millions of dollars saved, right? But that they never worked for them, didn't do anything to improve their quality of life in retirement. And so, they end up just hoarding it, right? They just hold on to their money and they're just sitting there, like I said, logging into their account every week, just admiring it. Oh, that looks like a great balance. Well, what's it doing for you? How is that impacting? How is that improving your golden years in life? How is that helping you to build the retirement of your dreams? It's not. It's just sitting there. It's kind of like having your own insurance policy almost. It's like happiness insurance, right? If I ever want to be happy, I know I've got this money sitting in this account. And one of these days, maybe I'll decide to be happy. Well, this is the key that unlocks that gives you that financial peace of mind so that you know how much you're going to get, and it's going to maximize it. Again, most financial brokerages are going to play that 4% rule. We're playing the 8.5 to 9% rule, right? And we want to lock that in, never have to worry about losing money. Again, we talked about the averages. Averages don't protect you, right? Sequence of returns risk is a very real thing. Whether the numbers happen, whatever the order that the numbers happen in has a huge impact on how much you'll be able to take every single year. Because again, if you take a 10% loss, that's 10% of everything that you've accumulated. And oh, by the way, Uncle Sam, okay, this is the part they don't talk about even. Uncle Sam is going to charge you based on whatever you accumulated, right? Not based on whatever you ended up with, whatever you accumulated. Whatever that highest balance was, if you earn money on that, that's what you're going to be charged taxes for. So again, this is just another strategy that we can replace that with that's going to help you to mitigate even the tax burden later on, because you're going to have stable income that's guaranteed that you're simply just going to pay, earned income tax unless we do a Roth conversion. Okay. So again, folks will see this. I just want something stable. Well, this is the most common desire. And again, with this strategy, completely achievable, right? So we don't need maximum returns. We need something that's going to last as long as we do. And that's exactly what these products are designed to do. All right. So what if I die early? Well, again, we said that the insurance company is not just going to keep your money. Okay. They're not just going to hold on. I mean, if both spouses pass away and, let's say there's still $100,000, let's say they both pass away at age 70. Okay. And we still got, let's say $200,000 sitting in the account. Well, guess what? That money is not just gone. The insurance company is not just going to pocket that money, right? That money is going to pass on to whoever their designated beneficiaries were. So whether that be the kids, the grandkids, whoever, right? It could be a charity for all we know. But that money is not lost just because they simply passed away early, right? If you were to roll the funds and let's say the markets took a 30% hit and you died the next day, okay, you're not going to lose any money. You would have, let's say maybe if it was $300,000 and we saw a market crash the next year, you're still going to have $300,000 in there if you haven't turned on income yet. And that money is just going to pass on to your beneficiaries. If that money was sitting in TSP, okay, hear me out on this. If that money was sitting in the TSP and we saw a 30% crash in the market, okay, how much would your family be left with? 300,000 minus 30%, that's $90,000 loss. So $210,000, okay? In this strategy, which incorporates the lifetime income, they're still going to have close to $300,000, right? It's not going to take a $90,000 hit, okay? They might lose 1%, okay? 1% is going to fluctuate a little bit because of the income rider, but beyond that, they're still going to have their principal completely intact, right? So that money that they worked so hard and that they earned and that they saved is still going to be there for their kids and grandkids. And ultimately, if you were to pass away early before your spouse, if you predecease your spouse has uninterrupted income that lasts for as long as they do, okay? Uninterrupted. No filing of paperwork, no delay. All we're doing is simply, submitting a death certificate to verify that the person, in fact, is deceased. But that income just keeps on coming as if it was never affected at all. Okay. Now, what about growth? And I know we're coming up on the hour here, so I want to just kind of wrap this up as fast as possible. Well, bottom line is you don't have to move everything. Okay. Some folks choose to just move a portion of their TSP, maybe 150, maybe 200,000. Okay. We can run those numbers and see what that looks like. We can grow the rest in a protected account. Okay. We've got protection accumulation strategies that are market protected, right? That are designed to do things like giving you upfront bonuses, right? We're running a few, marketing ads right now that talk about 14% bonuses. We've got ones that will give you up to 20%. Okay. So we've got ones that literally can give you bonuses. We can give you guaranteed fixed rate returns in that first year, potentially guaranteed fixed rate returns for 5 or 6 years, right? We've got all those options. So instead of just leaving the money again at risk in the TSP where it could lose everything overnight, you could potentially move some of it into an income strategy that's going to be guaranteed. And then some of it you could move into an accumulation strategy where it's also market protected so that if we do have major corrections or major market crashes, your money is going to be safe. It's not going to be affected by any of that. And what that's ultimately going to do is it's going to allow you to participate in more market gains. You're going to capture more of that upside potential in the market while not having to run the risks of losing a bunch of money if the market tumbles at any point in the future. Okay. So again, you could use part for income and use part for accumulation if you want to do it that way. And again, that we would call that a hybrid strategy. So kind of the best of both worlds. So you got two buckets. You've got guaranteed income on one side. You've got protected market growth on the other side. And we can split those and we can run them concurrently. And then ultimately we can even blend them together, right? So when we accumulate up to a certain amount, we call this laddering, by the way, we accumulate up to a certain amount in an accelerated account, right? And then we move that money back into the income strategy and we increase the income from there. So maybe the couple started out with, let's say, 20,000, and then, 5 or 6 years, 10 years down the road, they actually increased that 20,000 up to maybe 30 or 32 or 35, depending on how the markets performed in that amount of time, right? In 10 years, we could possibly double or even triple a principal balance. So that could end up being another, that could, in an income strategy, that could end up being another 10, 20, even 30,000 a year, depending on how much we're talking about. But again, when essential expenses are covered by guaranteed income, you never have to sell growth assets at the wrong time, right? That's essentially what you're doing when you're withdrawing from the TSP or you're withdrawing from your IRAs or 401ks, is you're selling growth assets. Okay, with this strategy, you can protect both. You can protect your income, you protect your legacy, and you ultimately protect your accumulated principal. And we can do all of that at the same time. Okay, why it works so well? Because again, we cover the essential expenses. So we have the income that covers the expenses. We eliminate the stress, right? There's no financial stress in this whatsoever because you know that your entire balance is market protected. And ultimately, we are going to protect our spouses so that when we pass away, if we predecease our spouse, that spouse is going to have that guaranteed income for the rest of their life, no matter how long they live. All right. So again, we're not after maximum returns here. We're after maximum certainty. Okay. Most financial planning out there is built around maximum returns. But in real practice, right? In real practice, we see that certainty matters more than accumulation. And I can prove that to you. Okay. How many of you would have given up your pensions at, let's say, the 10-year mark? If you're retired from the military like I am, how many of you would have given up your pensions in exchange for a higher salary over those last 10 years? Right? Let's say they offered to double your salary. If they offered to double your salary over those last 10 years, would you have given up your lifetime pension? Most of us probably would say no. Right. And if we did, our wives standing behind us would probably be like, you better not give up that pension. Right. So again, we're not looking for maximum returns. We're looking for maximum certainty. And that's what we get with these type of strategies. That's what we get with our RetireMax Elite private pension plan is we get certainty. We get growth. Okay. We get uninterrupted growth. We get uninterrupted income, but we are getting certainty. We're getting the ability to plan and we're getting the ability to maximize our savings and actually enjoy it during our lifetimes. All right. So again, how do we work with clients on this all the time. We've worked literally with hundreds up to this point since we've been in business. We do this on a one-to-one basis. And again, if you guys want to use that QR code that you see up there in the screen above me, okay, you can book your free strategy call. I also have the link down in the description or down in the comments there. It's calendly.com/victory-x financial. And you can use that link to book your free financial consultation. Again, we'll go over your numbers, right? We evaluate your plan. We look at the numbers. We see what's available. We compare the options. Okay. There's no obligation in any of this, right? We're not charging you. We're not charging you some kind of a consultation fee or saying, oh, well, you have to do business with us. If we don't end up doing business, we don't end up doing business. You'll walk away with the knowledge, I mean, what do you have to lose, right? What else? What do you have to lose, right? Now, again, this strategy is designed for people like you. It's people like you and me, right? So veterans that are working on building their retirement, potentially ones that are nearing their retirement. If you got, TSP, IRA, 401k holders, that's who this strategy is for. And those who ultimately want to convert those, very disciplined savings, right? Took a lot of discipline, a lot of hard work to build those nest eggs. You want to convert it into predictable income that's going to last for the rest of your life, no matter how long you live, and is also going to be there for your spouse if you predecease them. Or if they predecease you, it's going to be there for you, okay? So you want that predictability, and you have that money, and you don't really know what else to do with it, but it's just kind of sitting there at risk in the market. This strategy is designed for people like you. All right, now it's not a right fit for everyone, okay? If you're chasing maximum market returns and you like the idea of playing the lottery with the stock market, hey, more power to you, brother. I'm not here to tell you that it's right or wrong. There have been a lot of people that have made fortunes, by taking high risks in Wall Street. There have been people that have made high fortunes taking risks in the lottery and in casinos, okay? I'm not here to judge. I'm just here to educate, okay? I'm just here to offer you alternative strategies that are going to give you comfortability with your income from your savings, okay? Income that is substantial, okay? It's not just going to be, we're just liquidating at a 4 or 5% rate. No, we are liquidating at almost 10%, right? On a joint survivorship basis, we're liquidating at 8.5%, but almost 10%. So we're not just saying, we're just going to give you some crumbs every year. No, we're not playing the 4% rule. We are taking substantial returns and we're guaranteeing it for life. All right. So again, I put the calendar link up on the screen. Again, it's calendly.com/VictoryX Financial. I will hang out for just a few minutes. If there are any comments or any questions that you guys want answered, happy to answer those for you. But otherwise, I think we have kind of come to the end of the road here. We're kind of over time already. So I'm going to go ahead and sign off for tonight. If you guys haven't done already, feel free to check out our YouTube channel. We got some great free content. We're putting up new content every single week. Okay. Every week we're putting new content for veterans, and we'll also be featuring more content on Facebook and Instagram here in the near future. But again, ultimately, the best way to find out how this is going to work on an individual basis is to book that call. Okay. Doesn't cost you a dime. It's literally free. And if you guys, again, want a copy of Retire Max Elite, the Veteran's Guide to Tax-Free Wealth and Financial Freedom, just go ahead and comment wealth down below. And other than that, let's see. We don't have any questions right now. So again, I'll hang for a little bit. If you guys have questions, just post them in the comment. But I will see you guys again real soon. Hope you have a great week out there. And we will be back very shortly. All right. We'll see you guys. Take care.
It's your thing. Do what you want to do.